From Tycoon U Studios in Delray Beach, Florida, this is Options GPS with Chris Rowe and Ron Ianieri.
Welcome back to Options GPS. I'm Chris Rowe.
And I'm Ron Ianieri.
And it's time to tackle the butterfly. Now, the butterfly is pretty interesting because what you're doing with the butterfly is you're short a straddle, but you're also hedged at the same time. Remember we said you don't want to sell calls or puts naked, and if you're short a straddle, that's exactly what you're doing. But in this case, we're hedged. Why don't you tell them how?
Well, basically what we're going to do is we're going to sell that straddle that we said that you're not allowed to sell unhedged, and then use a strangle around that straddle to protect that straddle from the unlimited loss on the potential of either direction. So it's basically a delta neutral trade. So we really have no real lean to long or short, and we don't have to worry about the unlimited potential loss because now that we've butterflied our straddle, we now have a situation where we've got a limited loss profile. So.
All right, so essentially what we're doing in this case with the butterfly is we are short the straddle, so we're short the at the money, put and call, and at the same time we're long the next strike out of the money,
correct,
put and call, right?
Yep, we're going to use out of the money, put and calls in both of our long positions.
All right.
Keep them cheap.
So
that way we have less theta or decay in our out of the money options, and the heavy theta that we're collecting is right there at the money.
We're going to straddle and we're going to strangle.
Bingo.
All at the same time.
Yep. I don't know who's going to do the straddle and who's going to do the strangle, but it's going to be very interesting.
Well, why don't you show us how it's done?
Okay, you ready?
Mm-hmm.
Now, as you recall, I went on this huge tirade about not being able to sell straddles or sell strangles naked. And the reason is first off, the whole thought of you being naked trading options is extremely disturbing. However, that's not the naked I was talking about. I was talking about unhedged. And I understand that it's really hard to want to collect premium, have a situation where you want to collect premium, have a strategy like the short straddle and the short strangle right in front of your face that are unbelievably powerful premium collection strategies and not be able to do it because of the risk. It's very tempting to do those, don't get me wrong. What they decided to do, some genius in options way long ago, decided that, hey, you know what, I'm tired of not being able to use that strategy, the short straddle or the short strangle, for premium collection. There's got to be a way that I can harness that power of premium collection. And I told you there was. And what that is, for those of you wanting to use the short straddle, is the butterfly. The butterfly is basically a strategy that harnesses the power, the premium collection power of the short straddle, but offers a hedge. Now, obviously, you're going to have to give up a little potential premium that you could collect to put on your hedge. But this strategy is still very good at collecting premium, and it takes away the potential unlimited risk in case something happens that you don't expect. So let's take a look at the butterfly. The conventional butterfly is constructed by using either all calls or all puts. Many of you have probably heard of something called an iron butterfly. We will get to that. But we first want to take a look at the conventional butterfly. And that means we're either trading all calls, a call butterfly, or all puts, a put butterfly. Now, when we have the rest of the construction, now that we know we're using either all calls or all puts, the rest of the construction goes like this. You're going to be long one call or put of a lower strike, short two of the middle strike, and long one of the higher strike. So that means that if we are collecting premium and we are going to be short two of something, that short two options is always located directly at the money. Let me say that again. This is a premium collection strategy. It is fully hedged, but it is a premium collector. In the case of premium collection, we know that the optimal option to sell is the front month at the money. If we're going to do this butterfly as a premium collector, then our short 2 strikes, 2 of the 1 strike, the short option, has to be located for optimal value, has to be located at the money. All these options that we're going to be using in any of the butterflies need to be in the same month, and the strikes must be equidistant. You can't have a butterfly where you have the 22.5, 25, and 30. You can't do that because there's only $2.50 between the 22.5 and the 25, and there's $5 between 25 and 30. You would have to go 20, 25, 30. Same month, equidistant between the strikes. Let's take a look at our construction here. And the reason we're going to talk about only the long butterfly is that the short butterfly is a position the opposite of these. And in my mind, the short butterfly, if I was going to do one, why limit my upside and my downside? Why not just buy the straddle? So when I look at these things, I'm looking at long straddle, long strangle. If I want to be short them, then I go long butterfly, long condor. So the long butterfly for us investors, we investors, the long butterfly is really our short straddle. Keep that in mind. So here's the call butterfly. As you can see, we're going to buy 1 of the 60s. There's the lower strike. Sell 2 of the middle strike. And then buy 1 of the higher strike. $5 difference between each strike. There's our equidistant, and all in 1 month. Taking a look at that construction, where's the stock trading right now? Must be 65 if we're going to put on this butterfly in the optimal way. What about our put butterfly? Constructed the exact same way. All puts, strikes equidistant, all in the same month. Long 1 of the lower strike, short 2 of the next strike, long 1 of the higher strike. Where's the stock trading there? Again, 65, directly at the money. Remember, the at the money option contains the highest theta. If that's true, I want to be short it. And here I'm short 2. Now, when you're thinking about the butterfly, yes, we can think of it as our short straddle surrounded by a long strangle. That long strangle is our hedge. But we can also look at it as 2 conflicting vertical spreads. The conventional butterfly, either all call or all put, can be broken down into 2 different vertical spreads. The long butterfly breaks down into a debit trade, which will be a long vertical spread, and a credit trade, a short vertical spread. And both of them will be converging on that center price. Now, what I mean by converging is both make the highest amount of money in the center. Take a look at that broken down construction here. Here's a June 65 butterfly. Doesn't matter if it's put or call, does it? The construction is the same. So let's just pretend that this is the call butterfly. We're long 1 June 60 call. We're short 2 June 65 calls. And we're long 1 June 70 call. If we break that down and move it off to the right, we've set up 2 vertical spreads. We have 1, the long June 60-65 call spread. It's a bull call spread. That bull call spread is a debit trade. Meanwhile, we break out the other, and what do we have? We've got a short vertical spread. We are short the June 65-70 call spread, which is what? A bear call spread. We've got a bull call spread and a bear call spread. And if you notice, both have their maximum value occur at the exact same place. When you look at it this way, it's very easy to figure out in the butterfly where you want the stock to finish. right there at the center strike at expiration. That's the goal here. Now, with these two different vertical spreads, both of which have their maximum value at 65, we can see something else. One of these spreads at expiration is going to be in the money. The other spread is going to be out of the money. So that means one of these spreads could be as high as $5, and if it is, the other spread is at 0. If the stock closes at 70, we know that the 60-65 call spread will close at its maximum value, $5. But the 65-70 call spread, the one we're short, with the stock at 70, the value of that spread with the stock at 70 would be 0. That means the maximum value of the butterfly is the maximum value of a single vertical spread. Let me say that again. The maximum value of the butterfly is the maximum value of a single vertical spread. Both of these spreads are worth $5. Only one is going to expire with intrinsic value, unless the stock closes directly at 65. And even then, the 60-65 will close with full extrinsic value, and the 65-70 with 0. So no matter where the stock closes, one of these spreads is going to have the intrinsic value, the other will not. So if one of them has to be out of the money, and the other is in the money, the highest value the in-the-money one can have is $5. Thus, the maximum value of this butterfly is the difference between the two strikes. Ignore the third. See, the difference between the strikes is $5? That's the maximum value of the butterfly. Because one vertical spread will have full value, while the other will have none. And the full value of either of these two vertical spreads, being that the distance between the two strikes is equal, is $5. So the vertical spreads are really the key to understanding the butterfly. What about the functionality here? Number one, this is a powerful premium collection strategy. It is basically a short straddle surrounded by a hedge. Thus, it's a fully hedged position. This is why I said we don't want to sell straddles naked. We can't. There's just way too much risk. Who knows what can happen? Plane crashes into another building in New York. I guarantee the market's going to go to hell in a handbag, and this short straddle that you sold will wipe out your entire account. What do? We have to have a hedge. We can't short a straddle. So we buy a butterfly. We do the long butterfly. All the long butterfly is a fully hedged position. Which fully hedged position is it? The short straddle. Now, we can also look at it as two vertical spreads. And we know that both vertical spreads would have a maximum value, but a minimum value. So no matter how you look at the butterfly, you are in a position that is fully hedged and a massive, massive premium collector. Normally, it's a delta neutral trade. Because if we put on the butterfly, the long butterfly, we're going to short the at-the-money strike, two of them, and we're going to buy one out of the money, one in the money. The in the money and the out of the money, added together, deltas, normally add up to the same amount as the short at the monies. Think about calls. Say if I have that 65 butterfly on. I'm short two of the 65s, stock trading at 65. I'm long a 70, and I'm long a 60. Well, our 60 call is going to be in the money, probably around 70 delta. The two at the monies will give us a total of a short 100 delta, right? Because the at the money option, the at the money call, 50 delta. You're selling them, so you're negative delta. But there's two of them. So it's short 50 delta, short 50 delta, short 100 deltas. Meanwhile, your 70 strike, that out of the money call, probably drifting around 30 deltas. So what do you have? You've got plus 70 from your in the money, plus 30 from your out of the money. That's plus 100. And minus 100 from your two short options in the middle. Normally, a properly constructed long butterfly is a delta neutral trade, which makes sense because we don't want the stock to move. We're thinking sideways. We are thinking consolidation. We're premium collecting. We are hoping the stock doesn't move. Excellent for the use in consolidations, obviously. Stock has a big run. It gets into its new trading range, and what does it do? It kind of bounces back and forth in that trading range until the next catalyst comes along to either break it up and out of that trading range or down and out of that trading range. But until that catalyst comes along, now that it's developed a new trading range, it's probably going to stay in it for a while. Butterfly is excellent to use in that situation. It's a nice income generator. Every month we're doing a butterfly. Every month we bring in premium, provided that the stock stays where we want it to be. But we're hedged. We're not going to lose our entire family fortune off of some unexpected earnings announcement or statement or some type of news-related, geopolitical situation. We are fully hedged. And it can also be used to trade volatility skews. One skew in particular, the volatility smile. Profit and loss. First, we have to figure out our break-even. Where is our break-even? It's the point at which we neither make nor lose money. The break-even is very easy in a butterfly. All we have to do is take the price of the butterfly, add it to the lower option, and then subtract it from the higher option. So if we put a butterfly on that, let's just use our example we've been sticking with, the 60, 65, 70. If we put on the long butterfly, pay $2, our break-evens are going to be 62 and 68. How do I get that? I take the cost of the butterfly, $2, and I go to my lowest strike, which is a 60 strike, and I add it to the 60 strike. 60 plus 2 is 62. Then I go up to the high strike, the 70 strike, and I say, okay, 70 minus 2 is 68. That's all we have to do. Go to those two outside strikes, subtract the cost of the butterfly from the higher, add the cost of the butterfly to the lower, and there are your break-evens. Two break-evens here. Point of maximum profit. Well, here we have an option position, and we are short some options, and we're long some options. What is the rule of thumb about maximum profit when we have a position where there are short options involved? Our maximum profit is always at the strike of the short option at expiration. When we have our 60, 65, 70 butterfly, which is the short option? The middle one, the 65s. Our maximum profit will be obtained with the stock at 65 at expiration. And what is that maximum profit? Use the example I've been using. The 60, 65, 70. You paid $2 for it. What's the maximum profit? Well, we know the maximum value of the butterfly can only be the difference between the strikes. What's the difference between the strikes of the 60, 65, 70 butterfly? $5. Maximum value of $5. I paid $2. How much can I make? $3. And where do I make that $3? With the stock at 65, that middle strike at expiration. What about our point of maximum loss? Well, we have an option position here, don't we? And in this option position, we've got long strikes, don't we? And what do we know that rule of thumb is about buying options? We said that when we buy options, the last place we want the stock to finish is at the strike of our long option. But we have two long options here, don't we? We've got the 60 call and we've got the 70 call. So what does that mean? It means that the butterfly has its maximum loss occur at either the lower strike and below, or the upper strike and above. In our example, 60 and below, 70 and above. Our long butterfly makes money with the stock staying between the strikes, inside of the break-evens. We have to be inside of 62 and 68. 70 and above would be bad. Obviously, 60 and below would be bad. So the maximum loss is what in our example? Well, we know a couple things. Number one, the butterfly's maximum value can only be the difference between the strikes. What's its minimum value? 0. The minimum value of the butterfly is 0. If we paid $2 for this butterfly and it goes to 0, how much can we lose? Only the amount we spent, $2. And where does that loss occur? At the lower strike. The maximum loss occurs directly on the lower strike or directly on the upper strike, our two long strikes at expiration. Here's a chart of that. Let's take a look. We can see our area of maximum value lies between the two break-evens. That's what's the intersection of the red and black there. That's a break-even. And what is that break-even in our example? Our upper strike minus the cost of the butterfly, 70 minus 2, that's 68 right there. Stock is right here at 65. What's our downside break-even? The lower strike plus the value of the butterfly, that's 62 right there. Our point of maximum loss is right at the strikes. This bend right here is the 60 strike. This bend right here is the 70 strike. And as you can see, once we hit those points, no matter how far down we go, we're fixed at our maximum loss, which is $2. No matter how high we go above 70, we're fixed at our maximum loss of $2. What about our maximum gain? We know our maximum gain is $3. Where does that happen? Right here at the strike. So what we're looking for here is we are looking for a stock that is not going to move, that's going to stay within a certain range, and we're going to collect premium off it. But unlike our short straddle, which is a no-no, in my book at least, we have a limited potential loss. Have we given up some of the premium we could pick up by selling the straddle naked? Yes, we've given up some of that to obtain our hedge, our protection. And as an individual investor trading your own money, you've got to have protection. Remember, these professional traders, these floor traders like I used to be back when dinosaurs roamed the earth, remember, they aren't trading their own money. They're trading their firm's capital. If something happened to their trading account, the firm picks it up. They keep their house. They keep their car. They might get fired, but that's the end of it. Somebody else will hire them. Here, if you have the unlimited loss and you lose, it's your money you're losing. There's a big difference there, where you can have the knowledge of a professional trader, and you should demand that. And actually, you should want to have more, because the professional trader, they're not trading their own money. You are. This is why if we're going to want to sell a straddle, we've got to step back, look at a picture of your wife and kids, look at a picture of you 15 years from now with no money, and don't sell the straddle, buy the butterfly. You're going to make a little less, but when you get hurt, it's not going to be nearly as bad. What are the Greeks of the long butterfly? Well, first off, it's a delta neutral strategy. What's our gamma? Well, we're going to be short 2 of the at-the-money option. That means that we're going to definitely be short gamma, aren't we? We're going to be short a good amount of gamma. But here, I'm not so concerned about my gamma. You might say, well, Ron, that's going to change your delta. You're right, it's going to change my delta. But I am in a strategy that has a limited potential gain and a limited potential loss. My gamma can only go so high, And if worse comes to worse, and I buy a butterfly for $2, I know I can only lose 3. Doesn't matter what my gamma is. Normally, when you're looking at the Greeks are there to help you identify the total amount of dollars you can lose if the stock does something. I already know the total dollars I'm going to lose, and I know exactly where I'm going to lose them. Where the Greeks are critical, my understanding of the butterfly strategy answers the question of the Greeks for me. I don't need the Greeks to figure out the risk of this position. I already know it. Theta. Well, we're obviously long theta. It's a premium collection strategy. We are short 2 of the at-the-money options with the biggest extrinsic value. We are a premium collector here. We've got to be long theta. Vega. We're going to be short Vega. We're short 2 of the at-the-monies, long and out of the money, long and in the money. The in the money and out of the money don't have much Vega. In any given month, where's Vega the biggest? In any given month, right at the money, just like my other strike-based Greeks. So we're going to be short Vega. Does that mean we can vary in value with movements of volatility? Of course it does. But we can't exceed a maximum of $5. We can't exceed a minimum of 0. So we're in a sense, we're already locked in no matter what happens to the price of the options based upon movement of stock, passage of time, movement of volatility. This is one of the nice features of the butterfly. You know exactly what you can make and what you can lose, no ifs, ands, or buts, before you enter the trade. Let's look at the synthetics of this trade. Well, one thing you're going to know is that the long call butterfly is equal to its long put butterfly counterpart. And what do I mean by that? Corresponding options. The June 60, 65, 70 butterfly, call butterfly, is the exact same thing as the June 60, 65, 70 put butterfly. They are identical synthetically, and I'm going to show you that in a minute. There's no difference between these 2 trades. Hey, I want to buy a butterfly. Which should I buy, the call butterfly or the put butterfly? They're both the same thing. So what does that come down to in terms of decision-making ability? The fact is, we've got to look at the pricing. If they are identical, they should be priced the same. But because of different skews in the market, there might be an advantage to one over the other. If I know that the call butterfly is trading for $2 and I could buy it right now for $2, but I could buy the put butterfly for $1.80, buy the put butterfly. You've just increased your maximum potential profit by 20 cents. And you've lowered your potential loss by 20 cents. Now, these 2 are equal, but there needs to be an adjustment to equalize the 2 prices. You already know the adjustment. What is it? COC, cost of carry. We're going to have to adjust the long butterfly or the put butterfly by cost of carry to get an equilibrium in price. Now, short call butterfly equals the short put butterfly. That means if I want to get out of my call butterfly, I could obviously sell the thing. Right? Makes sense. I bought it, I sell it, I'm out. But because this and this cancel each other out, and this is equal to this, then my short put butterfly will cancel out my long call butterfly. So when I'm in the long call butterfly, I could either sell it out or I could sell the put butterfly. Why would I do that? Price. Again, all of this comes down to price. If I'm going to go in 20 cents better, say I decide, okay, long call butterfly trading for $2, long put butterfly trading for $1.80, there's 10 cents of cost of carry. That means the long put butterfly should be worth $1.90 when the long call butterfly is trading at $2. But it's not trading at $1.90, it's trading at $1.80. There's 10 cents there. An additional 10 cents for me. So what do? I buy my long put butterfly. It's going to do the same thing as the call butterfly at every single price level. Difference is I'm making an extra 10 cents, or losing 10 cents less if it turns out to be a losing trade. Now that I have it on, how do I get out? Well, I could obviously just sell the butterfly out, or sell through the put, or I could sell through the call. If I sell through the put, my sheets wipe out, my profit is there, done. If I sell it through the call, then I've got all these little different what? Boxes that form. And it gets all boxed off. Remember vertical spreads? We could box them off. I buy the call butterfly. Hey, I could sell the the call butterfly, or I could buy the put butterfly. There were two ways out. And it all boxes off. We've got a whole mess of vertical spreads here in this butterfly, don't we? They all box off. What's the difference? I go in the cheapest fashion. I buy at the cheapest fashion. I sell at the most expensive. If I'm long the put butterfly and the call butterfly is trading higher than the put butterfly, go out through the call. Make that extra 10 cents. Lock it in. Now, you could price one by the other. They're identical. You have to be able to price one by the other. If not, an arbitrage sets up. And we know that the market is not going to let you walk in, make a trade, lock in a guaranteed riskless profit, and walk away. Doesn't happen. And you wouldn't be able to do it. You would not be able to do it if you were trying to, even if it's set up for 10 cents, because the bid-ask spreads of all these four options would wipe out that little profit you had. So, but we could price one by the other. Call butterfly trades higher than the put butterfly by the amount of cost of carry. Take your call butterfly minus cost of carry should give you your put butterfly. Now, remember, when we're looking at the butterfly, we've got two vertical spreads. Now, they're not corresponding, so they don't box off each other. But each one of these two vertical spreads is half of a box. If I have two halves of boxes from one butterfly, I would have the opposite two halves of the box from the corresponding butterfly. So that's why I can close out my long call butterfly by selling the put butterfly. They'll close out due to the fact that I've got now four vertical spreads in there, two from one box, two from the other. Close it out. It'll still show up on your sheets until expiration, but the risk and reward has been now taken to zero. The risk of the trade has been taken out, and whatever profits, hopefully you have, are now in your account. Let's take a look at this. I said that these two are identical trades. If they are identical trades, they should add up to the same amount of cost. They should have the same risk. They should have the same reward. Do this on your sheets. I actually took these exact values directly off of your sheets. Sheet number 1. Look at our June 65 call butterfly. Stock is where? Got to be at 65. That's the option I'm short, right? That's the middle strike. So, with the stock at 65.50 on your sheets, I used those exact values. I'm not just making stuff up to just have it add up. June 60 call is worth 574 with the stock at 65.50. Check your sheets. The June 65 call worth 204. The June 70 call worth 39 cents. This is all with the stock at 65.50 on sheet number 1. Now, we buy the June 60 and we buy the June 70. And we sell 2 of the June 65. If you add that all up, it adds up to a total of a $2.05 debit. We've got to pay to do the long butterfly. But we know the maximum value of this butterfly. It's 5, isn't it? And we know that we've spent $2 on something that will or could be worth 5. If the stock closes at 65, we know one of the spreads will be worth 5, the other spread will be worth 0, and we will have attained the maximum value of the butterfly, which is $5. The maximum value of the butterfly is equal to the maximum value of the spreads. The maximum value of these two spreads, the 60-65 or the 65-70, is $5. A $5 difference between. So, my maximum profit would then be $3. I bought something for $2 that has a maximum value of $5. And since I bought it, what's the most I can lose? $2. I could lose $2, and I could make $3. Well, if the put butterfly is truly 100% synthetic to its corresponding call butterfly, then the prices should work out. Let's take a look. I took these prices directly off your sheets. This way you can see that, I'm not just making up numbers here. June 65 put butterfly. Stock trading at 65.50. The June 60 put that we're buying one of, 18 cents. June 65 puts, $1.48. We're selling two of them. June 70 puts, we're buying one at $4.84. Plus, plus, minus, minus. Add them up. It's a debit again, isn't it? $2.06. What is your maximum profit? $2.95. Identical, aren't they? Not only are the total debits identical, the total potential profits identical, and guess what? Where are both of these two butterflies going to make their maximum value? The exact same place with the stock at 65 at expiration. Where are they going to lose in maximum? Same place. 60 strike and below, 70 strike and above. These two butterflies, the call versus the put, corresponding butterflies, are truly synthetic. They're identical. Try a couple on your sheets. Try a couple Julys. Make sure that works. Now, how does the butterfly actually work? Well, the butterfly really focuses in on premium collection, the passage of time. So with all other things being equal, come expiration, as time has passed, if the stock closes directly at the strike, we're going to see our maximum value because the extrinsic value of our at-the-money options is bigger than the extrinsic value of the out-of-the-money and the in-the-money. We know that. And we're short two of the at-the-money. The total extrinsic value of our two short options exceeds the extrinsic value of our two long options. And seeing that we're all in the same month, these all have to come up to one date where all the extrinsic value is gone, which means they're all decaying over the same amount of time. That means that if they're all decaying over the same amount of time, the at-the-monies with the bigger extrinsic value have more to decay in the same amount of time as the two long options' extrinsic value. If we go back to that slide, add up the extrinsic value and see what I mean. And I bet you that the extrinsic value adds up to what your maximum profit is. Watch. 204 times it by 2, 408. With the stock at 65.50, we know that these two options are what? Each 50 cents in the money. So 408, right? We've got 408 here. We know that $1 of that 408 is what? Extrinsic. Now, we go over to our 60 strike. The 60 strike with the stock at 65.50 has 24 cents of extrinsic value. Our 70 strike out of the money has 39 cents of extrinsic value. Do the math. What you're doing is you're actually in a position where you're short a lot more extrinsic value than you're long. So this way, it works out that as time goes by, the value, the extrinsic value, superior extrinsic value of the at-the-money option decays at a greater rate than your out-of-the-monies. And not only at a greater rate, but more, because there's more of it to decay. When you look at the butterfly as two conflicting vertical spreads, you'll see that if the stock stays at the center strike, one of the butterflies will be one of the vertical spreads will be long, and you will be what? maxed value at $5. Our long vertical, the call spread, the 60-65 call spread, will be maxed out at $5. Meanwhile, the short vertical spread will be worth $0. If you are in that butterfly, you're going to be long the 60-65 and short the 65-70. The long one maxes its value at 65, and that's good for you because you've made money there. The short one has its minimum value occur at 65, and you're going to make money there because you sold it. Both of these spreads for the butterfly give their maximum value with the stock at that center strike. So both of our conflicting vertical spreads will both be at our maximum profit. Long the butterfly, we will be long the vertical call spread, which will go to 5. We will be short that other call spread, which will go to 0. Both have reached our maximum profit point at the same stock price. That's why I said they're conflicting. When to use this butterfly? Well, obviously, this is a premium collection strategy. And it's a delta neutral premium collection strategy on top of that. We use the butterfly when the stock is going to go sideways. Consolidations. That is when we're going to see our at-the-money option really get hit hard with decay, and our in-the-money option and our out-of-the-money option around it don't have as much decay. That's our hedge, though, in case the stock decides to take off in either direction. We want to look for, or actually, when we find a stock that has a sideways pattern to it, a consolidation to it, then we can look at the long butterfly. When we want to collect premium, I mean, whenever we want to have real super powerful, non-directional premium collection ability, we know that the Mac Daddy of them all would be if we could sell that straddle short. But there's too much risk for the individual investor. If I ever want to sell a straddle short, if I want to short a straddle ever, I don't. I buy the butterfly because that is the most powerful, fully hedged premium collection strategy. When volatility is skewed, well, this one is one of those things that I'm throwing in there now so that you know it exists. There are some people that have the technology to trade this, but it's still, shall we say, off in the wings in the future because individual investors, you don't have the access to the pricing models and the technology that's going to really help you do this today. In the future, you will, but not yet. When the volatility smile is skewed, you can use the butterfly to trade not a rise or decline of volatility, but an actual movement of the smile. Remember, the smile can get real smiley, or the smile can get only kind of smiley. If the smile is too peaked, it's too exacerbated, then what we can do is we can use the butterfly to help us trade the potential that they might lower the out of the monies or they might raise the meat, which is the middle. We can also use it to trade the opposite because we know that volatility is mean reversive. Thus, so is the smile. There is an average slope to the smile for every month. If that slope becomes too steep, we can sell the wings and buy the middle. If that slope becomes too flat, we can buy the wings and sell the middle. It all depends, but the butterfly would be the strategy that people use to trade inaccuracies or the mean reversion nature of